Matt Parrish runs a booming seven-figure business. He's got the S-Corp set up. He pays himself a salary and just had his best year yet. So why did the IRS still walk away with so much of his money? Today, we're pulling back the curtain on a real, unscripted, live tax savings session and showing you what's possible when strategy goes beyond the basics. And so if you own a business and feel like you've been hit with a tax planning wall, this episode might be the blueprint that you've been waiting for. Matt, welcome to the show.
Thanks, Mike. Appreciate it.
Yeah, and Matt sent over a bunch of stuff beforehand, so we were able to kind of deep dive into his tax returns and various things like that. And I really got excited as I was kind of going through Matt's stuff because there's so much potential for different strategies we can talk about, different strategies we can implement. And so I'm really looking forward to what we're going to talk about today. So just to get started, I want to give the audience kind of a background about what Matt has going on so they can kind of get up to speed. And Matt, if I'm mistaken anything anywhere in this description, just let me know. So first off, you have a business called DIY Retaining Wall LLC, and it's an LLC, taxes and S corporation, with annual revenue in the $500,000 to about $1 million, with expected profit this year of $300,000 plus your salary. And you're expecting that to increase by 50% to 100% next year as well. You've been in business for 4 years. You have one employee, but you're planning on hiring a lot in the coming year. You paid $30,000 in taxes last year. Does that kind of sum up kind of where you're at today and where you're at from that standpoint?
Yes, it does.
Okay, awesome. So that's kind of the starting point. Matt's got a really good business, and it's a really cool business. So if you're interested, check out the website. It's really interesting. But again, expected profit this year, $300,000 plus his salary. He's set up as an S-Corp already. Expected that to continue to increase, and really just sounds like you have a really good, strong, growing business, which is super exciting. So to get started, Matt, when you submitted yourself for this opportunity to have a live case study, you mentioned that you felt tapped out on the typical S corporation strategies, and so you're kind of looking at what's that next phase in tax strategy as your income continues to grow. And I just want to say first off, like, great job on being kind of forefront on noticing, like, hey, business is growing. That means my tax bill is also probably going to grow. And what can I do to try to help minimize that? So before we dive into actual strategies, I just want to kind of hear from you. What strategies have you already been implementing or feel that you've implemented when you talk about tapping out? What are some of the things that you've done that you feel like you've already done so far?
So first, I have an accountable plan in place. So I'm taking the home office deduction, taking a percentage of the home and subtracting out all the hallways and such for that. Anytime I leave the house for business, I'm recording that mileage, and I even have my mailbox set up close to where a lot of my kids' activities are, so I can kind of combine some of that travel. I have my parents on my board and my wife on my board, and so we'll have quarterly board meetings. Usually we'll do 2 at my house, and we'll take advantage of the Augusta rule for those meetings, and then we'll do 2 at my parents' house. And usually I'm just accounting for travel back and forth between those meetings. So we're not fully utilizing the Augusta rule, but we're using a few days a year for board meetings. And then let's see, I guess within the home office deduction, I'm accounting for all the internet and home repairs and mortgage interest and all that towards that that home office deduction. Let's see, I think that's basically the accountable plan is my main expenses I'm utilizing.
Okay, excellent. Yeah, and that's a great setup and great start. So I'm happy to hear that you have done those different things. One thing that I also noticed on your tax return is that you're implementing a capitalization policy, which is good. And for those that are listening, a capitalization policy just means that any asset that we purchase that's over $20 or under $2,500, we don't have to worry about capitalizing and depreciating it. We're just taking an expense for it. And I noticed that on your tax return, Matt. So that's something to that's something to think about. As far as children, you have 2 children, right? What are the ages of them?
They are 4 and 2.5.
Okay, perfect. So you're in the fun stages.
Yes.
I have a 5-year-old, 2-year-old, and a 1-year-old. So I'm in the
Okay.
same boat as you. It's a crazy life, right?
Uh-huh.
Um, and then you have a properly set up accountable plan that you're doing the reimbursements on. Are you doing those monthly, quarterly, annually, kind of just adjusting as you go along? How do you typically doing the reimbursements with the accountable plan?
Quarterly.
Okay, perfect.
Mhm.
Now, when the first thing that I kind of want to talk about is this concept of after-tax versus pre-tax dollars. And have you heard, whether it's the podcast or YouTube channel, have you heard about us talk about kind of what after-tax, pre-tax, what that means?
Yes. Mm-hmm.
Okay. So general concept is we don't want business owners to just go and buy things they don't need just to get a tax deduction. It's how do we take spending that you're already doing and find a business purpose for it, move it from an after-tax expense or spending into pre-tax spending. And so when I was looking through your books or through your tax return on the business side, I noticed a couple things that were kind of light. The first one was meals, and so you're talking about a board meeting that you had. So it looks like meals were somewhere around like $250 for the entire year was your total meal expense.
Mm-hmm.
And so I'm assuming that that came from the board. So you had 4 board meetings. I'm assuming there was meals involved with those 4 board meetings, and that's kind of the only thing that was taken on the meal side. Is that accurate? Does that make sense? Match to you?
Yeah, there might have been like 1 or 2 client meetings in there too, but for the most part, that's yeah, there are not too many meals in there.
Okay. And the only thing that I say that looks light, and so, obviously some people just don't go out to eat, and that's totally fine. But, first off, I think that making sure that we're taking advantage of everything from the board meeting side is important. So, whether that was $250 or whether that was more, at least we're getting that piece on the board side. The other thing that I like to talk about with meals is so often we're going out to dinner with people and we're talking about our business, even with a friend or a family member. So often we're talking about our business. And I'm not saying take every meal and try to make it a business expense, because the people around you will probably start wanting to go out to eat with you if everything you're talking about business the entire time. But what I am saying is that there's so many opportunities that sometimes people think, well, I'm going out with a friend, and that's the intention of this meeting. And then
Mhm.
all of a sudden we're talking about your business, and we're talking about, some of the struggles you're going through, or we're talking about how it's doing and what are some growth opportunities and what advice do I have for you. And so when I see meal expenses at say a $200 or even $500, to me, that just starts to click a trigger saying, hey, there might be more opportunity for more spending on that side. So
Mhm.
just something to think about as you're going along, and having different meals. And even if it's drinks, or even if you're going to a sporting event and you're having a meal at a sporting event, are we talking about business at that sporting event? Sometimes we are, sometimes we're not. And so it's just kind of analyzing that. Now, obviously the entertainment cost of the ticket to a sporting event would not be included, but any meals or drinks associated with that sporting event would be included if it was a business purpose for it.
Okay.
Um,
I
yeah,
did have
go
a
ahead.
question related to that. Like, a lot, sometimes I do talk to my wife about business when we're out to eat, but we also have my 4-year-old and 2-year-old. Is that like a red flag to the IRS to see, a Happy Meal on the receipt? If you are talking to your wife who happens to be a more board member,
Yeah,
like
that's a
about.
really good question. And so it depends on, how frequently it's happening, right? So I don't think that that's a red flag to have a child at a meal, a business meal. Sure, it's a little odd, right? You're not going to typically go to a business conference and meet with a bunch of colleagues and everybody have their kids there, but it's definitely not possible. So,
Mhm.
I think when you're looking at that, it's taking that opportunity to say, what was discussed there. Now, the other piece to that is that you're going to have some items there. Like, obviously, your 4-year-old probably isn't contributing much to the business conversation. Now, sometimes
Mhm.
they might, and you might get some insights from a young kid that you wouldn't expect. But what you can do is you could still run that expense through your personal account, but reimburse yourself through your accountable plan for the business related items. So for the
Okay.
meal for your wife and yourself, obviously, if you guys are talking business, that could be reimbursed. If the
Mhm.
kids have nothing to do with talking about the business or anything like that, don't worry about reimbursing them, but just reimburse for your portion of those meals, and just add it to your accountable plan. Just like when you're doing your home office, just like when you're doing your automobile, you can add that in there directly.
Okay.
Um, The other thing that I noticed is there was no travel related items on there too. And so, talk to me a little bit about travel. Kind of what do you guys do? Is there somewhere where maybe we could start to plan around how do we get more travel into our business to some extent, as much as possible?
Yeah, I say a lot of my travel, it's more driving, so a lot of it's mileage. Whether I'm doing a field visit or even those board meetings, we're driving. I will say I will have some more travel expense this year. We planned a trip to Chicago around meeting some clients and
Mm,
at at a conference, and we turned it into a family vacation too. This year I will have some more travel in there, but yeah, I think part of that too is just the young kid phase. It's hard to get family to go up and go to like where there's a big expedition or something and or
yeah.
expo and bring the family along too. Um, just kind of like the phase of life too. But yeah, we did have a couple trips like that this year where was traveling and using flights and hotels and such.
Yeah. Yeah. So that's just one thing to think about. And you're exactly right. Like I get the, young kid phase, like that's tough. And, how do you say go to Disney and then be like, well, by the way, dad's got to work for, half of every single day. It's tough. And we're not trying to like adjust family vacations to make things work, but oftentimes it can work. And so I love the idea of how do we, planning a trip to Chicago, how do we potentially plan business around that trip? And then the other thing too is that, with your business growing, you could also do a board meeting that's travel related. And so that could be a potential opportunity that if you are doing, one of those family trips, could we at least carve out a day or two that's a board meeting? And, maybe we find someone for the kids or something like that, that you plan a board meeting is part of a travel. And remember, when we talk about a day when we're traveling, for a day to be a business day, the majority of the day has to be spent on business. When we say majority, a lot of people are like, well, that's impossible if we're on a family vacation. But the majority only means 4 hours and 1 minute. So IRS looks at a business day as 8 hours. And if you spend the majority of that day, at least over 4 hours of that day on business, that's considered a business day. So it can very easily be, a board meeting from 8 in the morning till 1 in the afternoon. And then you're going out and doing whatever you want to do. And the IRS doesn't care. The IRS doesn't care what you're doing after that because your business day is locked in. So just one thing to think about on the travel side. I did. So a lot of times, and I just had your tax return, right? So I don't have all the details and every transaction, everything like that. I didn't see cell phone and internet on there. I did see cell phone, but it was like a $200 or $300, which seems light for a cell phone. And so it could be wrapped into like office expenses or something else. I just wanted to make sure that even though I didn't see it, sometimes it can be in there. It's just not, popping out at me, obviously. So I just wanted to make sure. And I know you mentioned with the accountable plan that you are taking cell phone and internet. So just making sure that we do that. The thing to think about is that oftentimes, even though your home office, let's say your home office was 10% of your house, mine's somewhere around the 10 to 12% of my house, but you can take more of different items. So my home office is only 10 to 12% of my house, but I have a cell phone and that's 80% business. And I have internet and that's 80% business. So you can take more of a percentage on those items that are obviously used more for business than say just the home office. So think about that on the accountable plan. If you're using like a worksheet or template for that accountable plan, make sure you're adjusting the percentages for items that weigh more heavily on the business related items on that.
That's a good point. Yeah, currently I'm just listing my internet and then taking, it's roughly 11% and
Yeah.
multiplying it by all the expenses. That's a good point.
Yeah, and definitely the cell phone, that the cell phone you would definitely take a lot of, and the internet, definitely I would say, especially if you're working from home, you're taking more than the 11%, maybe not 80%, maybe not 90%, especially if you're streaming and doing all those things. But, definitely feel free to get a little bit more aggressive with those items because they truly are, used a lot by your business, especially if you're working at home. You imagine if you work 7 hours a day at your home office, how much of that internet are you actually using in those off hours? Like you're probably going outside, you're probably, cooking dinner. Like, so you're not necessarily using the internet in a proportional difference. It likely is closer to that 80-20 type split. And then the other thing was auto. In auto, it's good that you're using it. Are you using the actual method or the mileage method currently?
Mileage method.
Okay. Yeah. So just something to think about there is, getting a new vehicle, that there's potential to look into the actual method if you start to get over 50%, and depending on the type of vehicle you have, it looks a little bit light, but not out of realm there. So I think it was like somewhere around the $2,400 was the reimbursement amount. So I think that mileage that adds up to somewhere around, like 3,000 something, 3 to 4,000 miles, which is, it could potentially be light. So just make sure that you're tracking that, have a mileage log that you're kind of tracking all of that activity as well.
Okay.
Now, for everyone out there, before we dive into more strategy, if this is something that you're enjoying, we work with small business owners going through hundreds of strategies every single day. At TaxZone, we not only do we offer unlimited access to our team of tax professionals, but we also have a complete system to fully implement every single strategy that's available to you. So go to taxelm.com, that's TAXELM.com, and book a free discovery call. Okay, so Matt, back to kind of what we were talking about. So you mentioned having a board and doing, your parents are on it, your wife's on it. That's great. Love that concept. Love this idea of a board. I think every business should have a board. A couple things to think about there. And let's talk about the frequency of it. You mentioned that you're doing it quarterly, which I think is totally fine. But as your businesses start to grow, so and I've looked at this last year, and you've had growth already here in 2025. You expect significant growth into 2026. One thing that you might want to consider is that instead of doing it quarterly, maybe we're bumping that up to a more regular basis. Maybe it's more of a monthly basis that allows us to not only, obviously help your business as it's growing and get insights from the people that are closest to you, but it's also going to bring those tax benefits as well. So the more meals, the more travel related, the more Augusta rule, 14-day home rental potentially rule related to those items. So just something to think about there is that, a business that's making a couple $100,000 a year, I love the idea of a quarterly board meeting. A business that's starting to cross that $500,000 mark and get even bigger than that, I think it's very reasonable to say, let's start doing these a little bit more frequently, more maybe on a monthly type basis.
Okay, that's good to know.
The other thing on the Augusta rule, so when you're doing the Augusta rule, what do you remember, just kind of offhand, what you're using as far as the reasonable comp for the reimbursement for that?
Let's see. I think I did like a single night hotel, like for my parents coming and visiting, and then like a rental of like our basically family room, dining room area. What that would be equivalent, renting it out at a local hotel for like a boardroom there. And I think I got like a comp for like I want to say like $600 or something to like rent out a space for a few hours, and I also got the equivalent price of renting a hotel room. And then I made sure it had like the boardroom had like the screen, monitor, whiteboard, like all the things that we would potentially need in a meeting like that.
Love that. And so I think that that's good. Again, we want to dot our I's, cross some T's on any type of tax strategy. The importance is knowing the strategy, then implementing it, and not only implementing, but implementing it correctly. And so it sounds like you've kind of started to dot your I's and T's, and which is really good. A couple thoughts on the boardroom. One, if you have an opportunity or want to take care of your parents in any sort of way, you also have the ability to do the Augusta rule with them, as long as they're not renting out their personal residence. Because you mentioned that right now you're quarterly. Hopefully we're going to move to monthly, but right now you're quarterly. And if we move to monthly and we're having half of those meetings at your parents' house, if there was ever an opportunity where you're like, hey, I just want to take care of my parents a little bit in some way or another, and I don't know their situation, but just know that as long as they're not renting their personal residence out, they can rent their personal residence out for 14 days or less and pay no taxes on it. So it would be a great opportunity that you could pay them for rent for their house, and they wouldn't have to pay taxes on it as long as their total rental days were 14 days or less. So a lot of people almost think that Augusta can only work on yourself. It works on everybody and anybody. It just, the reasoning in the reimbursement amount has to make sense for the scenario. So just something to think about there.
Okay.
Let's talk about your S corporation. So expected profit, and just remind me again, expected profit this year of $300,000 plus kind of what you're going to take as a salary as well. Is that correct?
Correct.
Okay. And what amount are you taking as a salary or planning to take as a salary?
Right now it's 80,000.
Okay. So And I just want to make sure we're on the same page. So $300,000 in profit, plus you're taking an $80,000 salary. So if you were taking no salary, you'd be somewhere in the $380,000 range. Does that make sense?
Correct.
Okay. So I think that the biggest thing, one thing to think about is we want to make sure that that salary makes sense. We want to make sure as a corporation, we're required to take a reasonable salary based on the work that we're doing. And so we don't want the salary to be too high because then we're paying more in self-employment taxes than necessary. We don't want the salary to be too low because now we're coming up to the IRS radar. I noticed on your tax return last year that you had profit of $50,000 and you had a salary of $77,000. So it looks like your salary stayed the same. It's just the business is growing, and that's why the profit has significantly increased from last year. When I look at, and there's two methods to determining an S-Corp salary. There is what I call a simplified method, where 30 to 50% of our profit we're taking as a salary. That's kind of just a back of a napkin starting point to say, hey, am I in a reasonable range that the IRS traditionally is not going to raise a red flag? Again, no guarantees, but at least gets us a starting point to it. Then the second piece is to say, okay, how much time am I spend being an engineer? How much time am I spent doing marketing? How much time am I spent doing administrative work? Calculate how much time you're spending on all those different activities on an annual basis or a weekly basis, and then annualize it and find a reasonable rate or what it would cost for each of those positions. So as an example, an engineer is going to get paid a lot more than someone doing marketing work or administrative type work. And so as a business owner, we oftentimes don't spend 100% of our time in our specialty. We're doing marketing, we're doing administrative work. And so that will tend to lead to a lower dollar amount for those specific items that we're doing. So that's the more complicated method where we're saying, okay, we want to concrete this reasonable salary. I talk about all that because when I see a salary of $77,000 with a profit of $50,000, if we do the back of the napkin, that 30 to 50%, that salary is probably too high. And we could probably go lower on it. When I see an $80,000 salary on a total of $380,000, that is obviously close to, what is that, 20%? Yeah, somewhere around the 20 to 25%. So now we've kind of flipped that script. And I like the closer to the 20 then versus the, over 50%. The biggest thing now, so if I would have talked to you last year, I would have said we can take your salary down a little bit. You might want to reanalyze that salary and bring it down a little bit. Now we're talking to it this year, and it's exact flipped. And so I'm not saying that we need to raise your salary. It's just that you're out of that 30 to 50% kind of back and napkin number. And so now we just want to make sure that that calculation that we did, we want to go to the more complex method and make sure that calculation that we did matches up, and we can find and provide proof on why $80,000 is a good salary. And so if we're ever under that 30%, I say we just need to make sure that we're doing that calculation to make sure that that is a reasonable number. Does that make sense?
It does. And I think my original number I was like working about 30 hours a week. And so I took the average engineer salary, but counting that they work 45 to 50 hours a week and multiplied it out. That's how I got that original 77 number. And then I, increased for inflation for this year, but I haven't revisited it again for this year other than that.
Yeah, so that's the only thing I would do is and again, you're just below what I call the safe range. And that 30 to 50% is just what I call safe. Like typically the IRS isn't going to touch it if you're in that range. You're below that, which is fine. But now we just need to make sure that we either raise it or, more importantly, I'd say before we raise it, let's run the numbers. So figure out how much time you're spent being, your profession, how much time you're spending doing marketing, how much time you're spending doing administrative work. And then there's a government website, and it's like gsa.gov, I believe it is, where you can look at wage rates in different cities. And so we could look at, how much does an administrative person make in North Carolina? How much does a marketing person make in North Carolina? How much does an engineer make in North Carolina? And we can say, hey, if you're spending 30 hours a week, maybe 20 of those are as an engineer, and maybe 5 is marketing, and maybe 5 is administrative work. And let's multiply that out by the hourly rate that's reasonable for your area, annualize it, and then make sure that we just have that support. Because if the IRS came knocking and said, hey, your salary is not reasonable enough, we have then a fight. We have proof to say, here's why we believe our salary is reasonable enough. And that's just that, again, that dotting our I's, crossing our T's on the implementation piece.
All right.
The next thing I want to talk about was retirement. What are you doing from a retirement standpoint currently? I didn't see anything on the tax return last year. And so a couple questions on that. One, how much do you want and can you afford to put away towards retirement? Some people are like, I'm not a retirement person. I don't put money towards retirement. That's fine. And we just want to talk about what our plan is otherwise. So, and it could be coming from your spouse as well. So talk to us a little bit about what retirement planning looks like right now.
Yeah, so with my wife's employer, she has 403b, HSA. So we're currently contributing to those. I do have a sole 401k set up. I have
Okay.
contributed that in prior years, and I think it was partially an oversight last year of not contributing to that last year. But yeah, I do have that sole 401k set up, and plan to contribute to it this year.
Okay. Excellent. So
So,
yeah, love a solo 401k, and whether it's Roth or traditional, you have both of those options obviously in there, and really high contribution limits to go into a solo 401k. I think the numbers this year is like 23,005 as an employee plus 25% of your salary. So if you're at 80, that's another $20,000 that you could put in there. So you're looking at 43,500 would be the max amount that you could put into a solo 401k. So some can get to some pretty big numbers with that. And obviously you can do less than that, but that's at least the potential that you have.
right.
I look at retirement as a deferral, or deferral of some sort. It's not a 100% tax elimination. It's a tax deferral in some cases, or we're getting no elimination today and a future benefit from it. So just something to think about there, as well as if you like to invest in things that are maybe outside of the stock market. One thing to think about too is a self-directed solo 401k. And so that's where you can invest in alternative assets. If you want to get involved in that, there's just some really cool plan opportunities where if you have friends that are opening businesses and you want to help fund those using a retirement plan and massive potential growth with that, there is different planning that you can do with that solo 401k where you could do a self-directed account with it as well.
And I will say that solo 401k, I set that up for that reason. I have like a real estate syndication I invest in through it, and I do have that capability through it. Awesome. I guess the other, like from the investment standpoint, I do try to invest in real estate through like syndications and get so where I'm a limited partner in those syndications, and so that was something that I was investing pretty heavily in recent years. Last couple of years have, with little kids and business growing, haven't had the time to like dive into researching those deals, but that is something that I have been contributing to previously.
Yeah. And another thing too, is if you ever get to the point where like, I want to put more away towards retirement and we're hitting caps on what you can do we could always say, hey, can we hire your spouse at all in your business? Is there anything that maybe your spouse could do part-time in her business and just put all of those funds that we're paying our spouse away towards retirement? So there is that potential. If you're ever saying, hey, I'm capping out here and I want to put more in, there is different, more advanced plan options that we can do. Or we can also hire our spouse and then start to max out their side as much as possible based on the work they're doing and everything else. So as you're growing and potentially able to put more away, something that there's potential there. And yeah, I love the idea of investing in real estate, especially if you're passive on the side. The problem with self-directed accounts, we just need to be careful about how active you're involved in some of those investments. If you're doing syndications, you're passive in nature. The beauty behind having those locked up in a retirement plan is that it's going to grow tax-free. And so whether it's on a Roth side or whether it's on a traditional side, it's at least growing inside that account and you're not taking taxes out now. You'll take taxes out later, but imagine you put $100,000 into a syndication that grew to $200,000 in a year, or in 5 years, 7 years, whatever it might be, grew to $200,000. You could then reinvest that full 200 because it's not taxed today. Whereas if you were on the other side, that 200,000, if you withdrew it, you'd have to pay taxes on it, and then you could reinvest it. But there would be a tax. Your investment wouldn't go as far because you're hitting taxes during the term of it instead of, if it's a traditional account, you don't pay taxes till the end. If it's a Roth account, it's growing tax-free anyways, and tax-free withdrawals too. So love the idea of kind of wrapping that into your retirement account, especially if it's something you want to invest in anyways. Doing a retirement account could be super powerful and just help that money grow that much quicker.
Yeah.
Real quick. So for those listening, if you're not quite ready to book a discovery call with Tax Zone, but still want more, we just released a brand new tax savings starter kit, and it's 100% free. Inside, you'll get our ultimate list of business deductions and real case studies showing how others have saved $5,000 to $25,000 or more. Just head on over to taxsavingspodcast.com/starter kit. That's taxsavingspodcast.com/starter kit. Okay, Matt, back to you. When we talk about HSA, you mentioned that your wife is using an HSA. Are you accumulating funds in that HSA, or are you just using that, putting money into the HSA, getting the tax benefit, and then paying medical expenses using the HSA?
No, we're investing it.
Okay.
So we're saving the receipts and trying to
Perfect.
save them digitally, and then investing that into like a stock fund or something, mutual fund.
Great.
Yeah.
And that's just what I always recommend to people, if you can afford it, right? Is don't use HSA funds. Instead, use your normal funds, pay for your medical expenses. And if you hit a money crunch down the road, well, then you have those receipts and you can get reimbursed for it tax-free. But I love the idea of having those funds grow in an HSA. Just keep growing tax-free. You get a tax benefit going in, tax-free growth inside of it. And when you use it for qualified medical expenses, tax withdrawal. So think of it as like a secondary retirement account. And you can also self-direct an HSA too. So something that if you're into that self-directing stuff and you plan on letting those funds sit there and grow for a while, and you maybe aren't going to need to be as liquid with it, you could also think about self-directing your HSA as well. Self-employed health insurance. Are you getting health insurance through your wife's employer?
Correct.
Okay, yes. That's what I figured. I didn't see any deduction for it, so assume that it was coming from somewhere and probably just not from self-employed. So that makes sense. All right. A few things as we get to wrap up here. First one, and this is just more of a comment. You had a lot of passive losses, and I'm assuming these are from some of the syndications that you've had that create that upfront depreciation. And so you're generating cash flow from those syndications likely right now, not paying any taxes on it. And I think there was like a $60,000 or so in carry forward of passive losses. So just know that if you have passive income, those losses will offset that. Or when you exit those syndications, obviously you're probably gonna have more than that, those carry forward losses. So you'll offset some of that income at that point too. Okay, let's talk about hiring real quick. You mentioned looking to hire this year. How many people are you looking to hire? Are these family members? Are these kind of outsiders? What does that look like?
Outside people. So probably the first position would be another engineer. So I'm looking to hire. I also I have about 4 or 5 contractors, 1099 contractors that I use for like drafting services. So, but as far as hiring an employee, I think my next hire is going to be another engineer.
Okay, perfect. So just something to think about as you're bringing on new employees, we need to think about that retirement plan. So work with your retirement plan provider when you're bringing them on to understand like how is that going to work, because no longer is a solo once you have outside employees, a solo 401k is not going to work. Now that could be a year down the road until they start to vest, and there's different things that you can work with on your retirement plan there. But check your plan document and work with your retirement plan provider as you're starting to bring those employees on, just so that you know kind of what your limitations are. Because let's say we're looking to hire next year and we know that we're not going to have a solo 401k opportunity anymore. Maybe that means, okay, let's bump up and make sure we're doing everything that we can to max out that solo 401k, as this might be our last year of it. Now, of course, we can go into a 401k moving forward, but just the benefits to max out that solo 401k and max out the employer portion just for you could start to go away as we start to add employees to it.
Okay.
The other thing too is obviously as we're looking to hire, we want to be competitive. And so a couple things about being competitive. Usually when we talk about hiring, there's 2 main topics. What's retirement options and what does healthcare look like? So retirement options, obviously, we just talked about that. Start to work with your retirement plan provider about what kind of options you have as you start to bring on employees. But when we look at health offerings, start to kind of run some ideas about what you would plan to do there. Now, some businesses can get away with 5, 10, 15 employees and not need to offer health benefits because they're getting it from their spouse, or they're using the money you're paying them, they're getting something from the market, and that's okay. But if we want to be able to get any talent we want. We might need to offer something competitive from a healthcare side. And especially for someone that's just getting started in that hiring process, I love the concept of a QSARA. So it's a health reimbursement arrangement. It's called a QSARA for smaller businesses.
Okay.
But basically how it works is you're offering a reimbursement amount where they go out, they get their own health insurance, they get whatever they want to do, they submit receipts, and you'll say, we'll refund or we'll reimburse you, X amount of dollars per month to cover healthcare costs. And it's going to be a plan across the board for all your employees. But it's an easy way to not have to dive into offering a group healthcare plan, but you can still offer a health benefit, and they just get to choose exactly what plan they want. So I know as a small business owner myself, especially when I started to hire a while back, I was always worried about this healthcare piece, because I'm like, group plan sounds crazy, and then I'm forcing them into a plan that they maybe don't want. And how does that work if they don't need a plan because they got it from a spouse? And it was a lot of confusion. And I wish I would have known about QSARAs back then, because it would have made that process a little bit easier. And then you can obviously grow and graduate into something else as your business continues to grow, but you at least have that solid plan for some of those initial hires. So something to look into is a QSARA plan as you're looking to hire.
Okay.
And then work opportunity tax credit, probably not going to be something that's involved with hiring an engineer, but it could be. And so look at the work opportunity tax credit. There's just some tax credits out there when you're hiring people from a distinguished group, depending if they could be military, they could be disabled, various different categories that qualify for that, lower income, where you can get a tax credit that can help offset some of the amount that you're paying them as well.
Okay.
Okay, so I know we're coming up on time, but I wanted to talk about this concept of kind of core strategies versus advanced strategies, because you are starting to get into the realm of where advanced planning, advanced strategies are going to become available to you. And when we talk about core strategies is a lot of what we talked about today. So think of things like an S corporation, retirement, home office, hiring your kids when the time makes sense. Obviously, it might not make sense now, but that will come out down the road. Setting up a board, Augusta rule, doing all those things are what I call core tax strategies. And core tax strategies are available to people making $10,000 a year to people making $10 million a year. And that's what we love about core strategies. We say we always want to implement core strategies as much as possible. And once we've done everything we can on the core strategies, and you're getting close to getting there, then we're going to say, we still have a tax bill. How do we solve that? And that's when we look into advanced type planning. And advanced planning, I like to break up into 5 main categories. And then within each category, we have multiple different types of strategies or different versions of that strategy with different partners, different ways to do it, but they all fall in kind of the same category. And so when we talk about advanced planning, there's advanced retirement planning. So before we look into advanced retirement planning, I'd say let's make sure we're maxing out our 401ks and everything we can do there. If we're doing that and we still want to go into more retirement, there's some advanced planning that we can do on that side. The second concept we talk about is asset purchase strategies. Then we talk about asset donation strategies. We talk about investing in oil and gas and taking the tax breaks from that. And then we talk about captive insurance. So in your specific state, I would say advanced retirement planning, not necessary yet until we get to the point where we're already doing everything we can there. Then we'll talk about that. Captive strategies start to come into play once we hit about 150 to or 1.5 million to 2 million in revenue. So again, a little bit down the road, but that can provide as another opportunity. So really kind of the 3 main categories we look at for you is asset purchase strategies, asset donation strategies, and oil and gas investments. Now, we could also add on real estate and maybe doing a short-term rental with real estate. And how can we do a short-term rental? Use that to offset your income, and a lot of planning with short-term rentals on real estate, a lot of wealth planning with long-term rentals on real estate. So you could probably add that in as a secondary bucket as well. But that's where we would start to go down and start to explore some of these additional opportunities to say, hey, we've done everything we can on the core side, but our business is growing, we're doing really well, and then we still have tax problems. Now we can start to eat away with that using advanced tax strategies. And advanced strategies can make a big impact really quick, depending on kind of what strategy makes sense. And like I said, within each of those strategies, so within asset purchase strategies, we have things where we're talking about solar related items. We're talking about software. We're talking about heavy equipment and how we can start kind of a business to help take advantage of depreciation, tax credits, and different things like that. Within asset donation, we're talking about land and donating land or tangible assets. So think of it kind of this way. Let's say you bought a stock for $100 and 2 years later, that stock's worth $500. If we then donate that stock to charity, we're going to get a $500 charitable deduction, even though we only paid $100 for that stock. And that's because we get a donation based on the fair market value of that stock. So those are some of the advanced plans that we'd start to look into once we've kind of capped out the core tax strategy side.
That's something I'm trying to work with my church on, setting up like being able to accept crypto donations, so that we have a little bit of crypto that has appreciated, that we could just take advantage of that strategy there too.
Yeah. I love that concept because, right, if you're going to be donating anyways, I'd rather see you donate a stock or donate crypto and let the church eat that capital gain, which they're not going to eat that capital gain because they're a nonprofit. And so, yeah, definitely work with the church. I mean, I'm on the finance team at our church, and I said we will do anything possible. We'll open up whatever account we need to, because as soon as we get it, we're just going to sell it and convert it to cash anyways. Right. But I'll open up any kind of account you need if it's going to mean, making it a tax benefit for you, and also obviously benefiting the church as well. So definitely work with them on those things.
Yeah.
So, Matt, we could go on for hours, but what we're really doing is just kind of getting started on different planning opportunities, and then taking the opportunities that you're already implementing, which is great, but just optimizing them a little bit more, making sure that what we're doing is first off, dotting our I's, crossing our T's, making sure we're implementing it correctly, but then making sure that we're implementing it to the fullest extent possible. Because so many people say, well, I've heard of this strategy, I've heard of that strategy, but then when we start to get into it, it's like, but you're not implementing it, or you're not implementing it to its fullest extent. And so we always say that tax planning is something we're continuously doing around. Although accountable plan is something you can set up and kind of forget about, we still want to be revisiting that to make sure we're always maximizing it year after year. And that goes with any type of strategy. So Matt, has this been helpful? What are some of the things that kind of you've taken out of this that you're going to say, hey, that's something that is an action plan today, and then maybe something I want to continue to dig into to see kind of what options are out there for that?
Yeah, definitely. I think some of the things that my key takeaways, increasing board meetings, since I'm hitting higher revenues, increasing those to once a month instead of once a quarter, and taking more advantage of meals out. And even if I have my kids with me, but we still talk about business, just taking the people that are associated with that meal and reimbursing myself for that. I think those two will be big things that I'll start implementing right away. And I know I need to revisit my reasonable salary, so that's something I'll be working on, and might not be going up or down, depending on what that calculation comes out to. But I know that's something I need to probably dot my I's, cross my T's a little bit better on, and point out, like, increase my retirement savings. That's something I can start doing this year. So I missed that boat last year, just kind of got behind the eight ball, but something I want to take advantage of this year.
Yeah, no, that's great. And a lot of times too, when we're talking about tax strategy, sometimes it's not necessarily that we're changing anything, but it's just making sure that we're creating a rock solid foundation, and your salary is the right piece, right? Like, if that salary makes sense, totally fine. But let's just make sure then we have the solid documentation to support it, so that if the IRS does come knocking, we don't have anything to worry about, because we've already done the legwork for that. So a lot of times when we talk about tax planning, it's, hey, you might be implementing it, but are you doing it correctly? Are you dotting your I's, crossing your T's? Do you have, if you're doing the 14-day home rental, are you just saying, oh, I'm just reimbursing myself $10,000 for a meeting? Well, that doesn't make sense. So it's kind of putting that legwork to make sure that it's solidified as well. Or if you're only doing $100, that also doesn't make sense. Let's do some more research on kind of what is reasonable, and start to dig into that. So Matt came in thinking he'd already squeezed all the juice out of his S-Corp setup, but by the end of our session, we've kind of uncovered a path to cut his tax bill more. We've started to talk about advanced strategies and kind of where the potential there would be a significant cut into it. And a lot of the stuff, it's not magic. It's just strategy that most business owners never hear about, or never think about, or never put to fruition. They never complete the setup for it. And if you're listening to this thinking, wait, I could be missing something too, the answer is probably yes. Start with our free tax savings starter kit at taxsavingspodcast.com/starter kit, or book a discovery call with our team at TaxElm. You can go to TaxElm, that's TaxElm.com, and let's uncover your hidden savings. Either way, don't leave thousands of dollars on this table. And if you found this helpful, don't forget to hit subscribe, hit that like button, and share it with a business owner who's sick of paying too much in tax. Matt, thanks again for coming on. And I cannot wait to hear your success story and kind of where you go from here and where you go from a tax planning expert. And I want to reiterate this again. You taking action in looking at saving on taxes as an opportunity to help grow your wealth and grow your business is an excellent step that you're taking. I just want to say you're doing a great job.
Thank you, Mike. I appreciate this.